Today, we're going to start off this presentation with 10 of the questions that we received from you all's email response. Now, we got more than 10. I know we got a lot, so if you don't hear your questions asked, trust me, we've tried to weave it into other questions because we just, with the amount of questions that we got, we just don't have an hour. We got 30 minutes, and we want to make sure that we deliver impactful information that can make a difference in your retirement. So here's how the plan is going to go today. I'm going to take those 10 questions. I'm going to go through those 10 questions, answer each and every one of them, and then we're going to flow into our slides. And then that will be our presentation for the night. And so what we want to do now is we're going to go to the first question. Do you calculate your FERS retirement annuity? That's a really important question, especially for people that are retiring this year. You're getting these estimates from your HR department. I was talking to a lady yesterday. Her HR department was non-responsive to her, so she was having a hard time, right? And so here's how you calculate your FERS retirement annuity. It works in two different phases. You have your post 62 folks, and then you have your before 62. So if you're younger than 62 and you're retiring, you want to take your high 3 salary estimate. So you add your last 3 salaries up, divide that number by 3, you get your high 3 average, okay? Then you times that by the amount of years of service that you have, right? So let's say you have 20 years of service. Then you take your high 3 salary, let's say it's $100,000. You times that times 20 years of service, and then times 1%. Then you'll get a number, and then you divide that number by 12. Okay, that's how it works if you're under 62. Now, if you're over 62 and you have 20 years of service, it works a bit different. You have to multiply it times 1.1. So let me run it to you again. Let's say your salary is $100,000. So you take 100,000, you times that times, let's say you have 25 years of service. You times that times 25, 100 times 25 times 1.1%. You're going to get a number. You divide that number by 12, and that gives you your monthly FERS pension amount. So in essence, if you work to 62 and you have over 20 years of service, you're getting a 10% raise per month on your FERS pension. So that's why most people wait to 62. Not saying you have to, but that's why most people aim for 62. Okay, so we got a question from Ms. Hill over at the CDC. And she asks, can I live off of $4,000 a month in retirement? You can live off of $4,000. You can live off of $8,000. You can live off of $10,000. It just depends. I've had clients who feel broke with a $10,000 retirement income when it comes to their pension, Social Security, TSP. I've had clients who felt broke at $8,000, $4,000, and I've had people that had $4,000 and they felt like that was enough. It just depends on how much you're paying for things every month. And that's why individual planning matters so much. And so, Ms. Hill, if I was to meet with you or our team was to meet with you, one of the things we would ask you is like, okay, what do you need every month? If you say 4,000 is what you need, then we would start planning backwards from there. But to answer it in a nutshell, it just depends on where you are in life. There's no magic number to it. It's just you have to plan for whatever your number is and then work backwards from there. Super important, but it doesn't really matter what your pension is. It could be 10,000, it could be 4,000. It's all about what your bill structure looks like. So Anita asked, how much money should she put aside while she's waiting for a retirement check to be processed? So Anita, at this time and place, the OPM is just slow, right? With the amount of people that retired last year. I have people that retired in September and are just getting their retirement check this month, starting in May. Right. And so you look at that, that's almost 6 months, I believe. And so when it comes to how much you should put aside, we always tell clients at least have 6 months of savings put aside, just because you never know, right? You never know what the workflow is going to be like at OPM, because here's how it works. When you retire, you'll get your annual leave check payout. You'll get your Social Security. If you're collecting Social Security, you'll start getting that. You'll get a portion of your FERS pension. You won't get the whole thing. So they'll send you a quote unquote estimate. The estimate is always short. Most cases, sometimes it's 60%, most times it's 50%. It varies in between that. Sometimes it can be 70, but it's just an estimate. You're not going to get your full thing. The good thing is when you do get your full retirement check, they give you all that back pay, which is great. But I always tell folks, make sure you have at least 6 months set aside, if at all possible. if you're over 59 and a half, just take the money out of your TSP. Yes, you might get taxed. But you can plan for that. Or if you have some money in your Roth, you can go there. That way that money's tax free. So don't stress about it, but just making sure you start putting money aside. So if you're watching this and you got a year or so out from retirement, start making that plan to set money aside, because you just never know, right? You just never know. Another thing is you're going to get your annual leave. And so your annual leave, sometimes you can calculate that, and that can help you out a lot. That helps a lot of folks out. But we like to say at least 6 months, just so you have peace of mind and you're not stressing. Okay. So Eric from the VA asked, does your FERS pension increase with inflation? So yes, we like to call it a diet cola, right? Because it doesn't match inflation every year, but it works like this. If inflation goes up to 2% that year, then you'll get the full 2% increase. If inflation goes up 3%, you still get the 2, because they minus it by 1. If inflation goes up 4%, they always minus it by 1% of whatever the actual inflation number is. And so you're going to get cost of living increases. But here's the thing. When it comes to the cost of living increases, your cost of living increases does not take effect until you're 62 years old. So if you're retiring at 57, you're not going to get any cost of living increases until you're 62. So for all you early retirees, you definitely have to make sure your TSP is growing to outpace inflation, so that you can add extra money to your TSP, so that you're offsetting the lack of COLA that you're getting during that time period. But Charlene from the VA, another VA employee, asked, "Is there a FERS pension increase in 2027?" We don't know what the inflation report will say yet, and so you always know if there's going to be a cost of living increase based on the inflation report. And so we won't know that until the end of the year when the inflation numbers come out. Okay, so Michael from HHS asked, what order should you file your retirement paperwork in? Should you do your TSP, your Social Security, your FERS benefits? And so we like to say your FERS benefits and your Social Security, especially if you're over 62 and you want to take your Social Security, you should file your retirement paperwork first. And then once that gets approved, then and your retirement date is set and you're actually retiring, then you can file Social Security, because Social Security pays a lot sooner than the FERS pension. The FERS pension, you have to wait. And then when it comes to your TSP, if you're under 59 and a half, you can't do anything with that until you are actually retired and they have your retirement paperwork. If you're over 59 and a half and you're looking to draw down income on your TSP, I would say just wait until you're retired to start doing the income. But also wait until you start getting your FERS pension, your Social Security, to understand exactly how much income you're going to need and how it's going to impact you before you start taking money out of your TSP. Because oftentimes, especially if you do proper planning, you might not need as much income as you think out of your TSP. If you do, you can begin to start the TSP process. What I will say, though, on the TSP, make sure you have your accounts added, so that when it is time, you don't have to wait that 7 days for the 7-day approval. You can just start drawing down money immediately instead of having to wait for the verification and things like that. So make sure you have your accounts added that you want the money direct deposited into. And then also when it comes to the TSP, making sure you have a strategy around taxes, because you might be on the bridge of one tax bracket and then you might take too much money and it might cause you to go into a higher tax bracket. It could affect your Medicare. You want to make sure you have a plan when it comes to drawing down on the TSP. Okay, so Kathy from the post office asked, can you roll your TSP into a private account? Yes, you can, especially if you're over 50. You can't do it, Kathy, if you're under 59 and a half and still working. If you're under 59 and a half and you're retired, you absolutely can. But if you're in, let's just, I don't know your age, Kathy, but let's just say, Kathy, you're over 59 and a half. Yes, you can roll your money into a private account. The thing you have to think about, though, you have to make sure you're moving your money from a qualified account to another qualified account. Now, what do I mean by qualified? So your traditional TSP is considered qualified money. That means when you're putting money in there, the money is tax deferred. And you notice that because when you file your taxes are always lower than what your actual income is, because the TSP is a write off technically on your taxes. So you're paying less taxes. Now, when you retire, you're eventually gonna have to pay that money back. That they just deferred the taxes. So whenever you roll your money into an account, you want to make sure you're rolling it to another qualified account that does tax deferred. So here are the type of accounts you can roll it into. You can roll it into an IRA, a traditional IRA, or if you're working at another job and it's like a 401b or something like that, you can roll it into those type of accounts. And when you or another 401k, if Kathy, if you look at if you have another job and you consider that private, you can move it into those type of accounts, and that's considered a rollover. When that happens, you're not taxed. But if you roll it into a private account, like let's say your bank account or a money market account or a private CD or something like that, you are going to get taxed. So the answer to your question is yes, you can move it to a private account under all circumstances as long as you're over 59 and a half. But there's taxes involved if you roll it to a non-qualified account. There's no taxes involved if you roll it to a qualified account. So, okay, so this is a similar question to the last one. Kimberly asked, what should you know before rolling money over into a private account? And so when you rolling money into a private account, some of the things you want to think about, obviously, like I just mentioned, the qualified versus non-qualified, that's one thing. You also want to know what is it that I'm rolling my money into, right? Like what type of account am I rolling this into? And again, it's two types though. It's the tax status of one, that's the qualified versus non-qualified. So that lets you know if you're going to pay taxes when you do the rollover. Then you want to know, and like I'd like to say, those are like vehicles, right? You either have taxes or non-tax. That's two different vehicles. But then inside of that vehicle, there's a whole lot of options you can choose from. And so you want to know what the fees are associated with what you're rolling your money into. You want to know what the historical returns are. You want to know why I'm doing this and what impact that will get. And that's a whole large conversation, but those are just some high level things you want to think about. Okay. I got a question from Adam from the Department of Interior. His question was, what is a good tax strategy before he draws Social Security? So Adam, I'm assuming you're retired. Adam. And that's a really good question. So the best way to handle taxes before you draw Social Security and retire is to start moving money from your traditional TSP to the Roth IRA or Roth TSP. Either one works, right? And the reason why is because at this point, Adam, you are in your lowest tax bracket. So while you were working, you were at a high tax bracket, right? Let's say you were making 100,000. Now you're probably making around 40 to 50,000, maybe, right? And so now you're in a lower tax bracket. So now is a good opportunity for you to move money from that Roth IRA, from that traditional TSP to a Roth IRA, because your taxes are going to be lower than they've ever been. Now, also, when you start filing Social Security, your tax bracket may go up. It just depends, right? Let's say your Social Security income is another 20,000. Now you're up to, let's say if you're making 50, now you're up to 70. So you're in a slightly higher tax bracket. So right now is a good time, prime time, to start moving money from that traditional IRA or traditional TSP into Roth IRA, so that once you take Social Security and your income continues to go up through the cost of living increases that I talked about in an earlier question, you're paying less taxes on that money. So the Roth IRA that you move now can grow and grow and grow over time. Okay, so that's our 10 questions for today. Adam was our last question for today. So again, thank you all for sending in those questions. Sorry we couldn't get to all of them, but hopefully your questions were answered inside of other questions. Our team tried to make that happen today and really pushed me to make sure we got all the questions answered within the questions. But now what we're going to do is we're going to transfer to the slides and take you through those slides. So today I'm going to walk you through a scenario that I had 2 weeks ago. I had two clients. I met them on back-to-back days. And I think this scenario is really important, especially with everything we have going on in the news. Something that we always talk about at Fed Legacy is it's better to have a plan than no plan, because if you have no plan, you panic. And so if you think about the last couple of months, in March, the market was down. In April, the market was back up. Now we're headed into May, and there's rumors that we might go back to war. We don't know what's going on, but what do we do in that situation? And so one of the things that we always talk about is making sure you have a plan. That's why we have the financial house that we created here at Fed Legacy to give you a framework that you can live within that makes sure that when times go crazy, you can stay steady. And so I want to walk you through a client named Denise. Now, obviously, we changed the name. But Denise, when she came to us, she had $250,000 in her TSP. 85% of that is in the G fund, and she's 8 months out from retirement. Okay. And we talked to her in March. She was terrified. Into March, she was terrified of everything that was going on in the TSP. And the thing about it is, she was when we were talking, she was talking about, okay, I need this money. I moved this money to the G fund, Ms. Smith, because I needed to be safe, because I need it for income. And when we looked through her strategy, when we looked through her retirement analyzer, it was obvious, yes, Denise needed this money for retirement. And so we ran her numbers. Her $250,000 would allow her to have $1,200 a month on a 3.5% return. Right? That's it, $1,200 a month. But then when we ran it with a diversified plan, I put it through our financial house system. It was at $1,700 a month. That's an extra $150,000 over her lifetime when we diversified that money. That made a big difference for her. So she was thinking, I need to be safe, but that $1,200 a month that she would get with the money being in the G fund just wasn't enough. When we ran it for the 17, that's exactly where she wanted to be, but she didn't understand a diversified portfolio. Now, when it comes to your retirement, there's 3 things you got to think about that can affect you when you're thinking about playing safe. Now, if you're anything like Denise and you're thinking, okay, everything is going crazy with the markets, what do I do? Here are the things that are working against you. There's a projected to be a 0% raise on civilian pay. That's a proposal that's out right now. That's currently talking about in the news. 0%, right? So inflation has been going up, but you're getting a 0% raise. Also, FEHB up 12% this year. If the G fund is at 3% return, whereas inflation's been up 4%. Those are big factors when it comes to you playing it safe in retirement. So if you're anything like Denise, doing 100% G fund is a huge risk when the amount of money that you have in your TSP is basically almost staying flat. Your pension is almost staying flat as well, but the cost of your healthcare is up 12%. In the long run, this can be detrimental. And this is the reason why you have to have a plan, right? And so this is why we have the financial house. The financial house strategically puts protection money in place. Now, you definitely have to have some safe money, no question about it, but you have to have it in a strategic way. We talk about the foundation, which is your protected money. We also have the walls, what we call your taxes and inflation insulation money. Because just like your house, the 2 things you cannot predict are taxes, what they will be when you go to withdraw them, and what inflation will be. So we go back to Denise. Denise is getting ready to retire, but the federal employee health benefits went up 12%. Her money's in the G fund earning 3%. And so as I told her, I'm like, look, you have to have your money growing the best you can. Now, obviously, you can't control the market, but you have to have a strategy in place that doesn't lock you down in the basement. So you want to make sure you have a plan that can navigate the market with inflation to make sure that your money is always growing at a pace that's acceptable. The next piece we call the roof. The roof is growth and market upside. So whenever we're talking to folk and they're TSP millionaires in the TSP and they've had it a while, they always say, well, I just put money in the C and S. I just left it there. Right now, and that's a 20-year strategy. That's not a strategy you have when you get ready to retire. But I say that to say is like you shouldn't just abandon the C fund once you're ready for retirement. You want to have an appropriate amount of money still sitting in the C fund because you still want to be able to take advantage of the market upside. So like, let's go back to March and April. The people that we talked to that had 100% of their money in the C fund saw a dip. I was talking to one guy. He had a lot of money in his TSP, but he lost $200,000 in March. But in April, he got the $200,000 back. Huge swing. But if at that point where the market went down 200,000, if he would have moved all his money to the G fund at that point, he would have just locked himself in the basement and never got that $200,000 back. Now he's at a point now where he's like, I don't want to play this game anymore. So we're now starting to diversify, but we're not moving all of the money out of the C fund. No way, because you still want to take advantage of that upside. So you want to make sure you have that foundation, the walls, and the roof. Now let's talk about Paula. Paula, who I met the same week, I met Denise. She had $650,000 in her TSP because Paula has been more aggressive, right? Paula also is retiring in 8 months, but she had 77% of her money in the C and S fund. She had 33% in the G. Now, with Paula, she made sure she had that 33% in the foundation, which is solid, right? Because she knew, okay, if I live off of this 33%, I'll have this protected, then I'm good, right? And so, again, with Paula had already came to us and she had already talked about, hey, I want to start doing Roth conversions and things like that. She came with that. We validated that plan for her. And again, she has 77% of her money in equities. So she had already built out a financial house in her own mind, which is great. And the big thing about Paula was calm when she came to us. She came to us as a referral, but she already had the financial house impact. She had her 33% set aside in a protected amount because she knew that this is where I'm going to go to if I need an emergency for income. And we validated it to her. Like, yes, this is where you go for income. You have your Roth conversion strategy already set up. You have 77% of your money in equities. We started to begin to take some of that down though, because that was a bit high for where she was, but she still had the right mindset. And so when we talked to her in 8 months, she's feeling very confident. Denise, on the other hand, wasn't feeling very confident because, like I mentioned, she didn't have the right structure. And so what does that mean to you? In times like this, where every month it seems like it's a different headline, are we going to war? What's going on with gas prices? I mean, I was booking flights this past week. I tried to book a flight Saturday. I went to rebook it on Wednesday. The price is doubled. Today, I went to rebook it. The price is doubled. And so, and I actually put a Google search in. I was like, airline prices. And they talked about how airline prices increased this week. Like, all these things are impacting us. And so what you want to make sure you have is you want to make sure you have a plan that no matter what the economy does, you're not panicking, because the worst thing you could do is panic in times like this because everything is so unpredictable. You want to make sure you have a plan that's in place. And so the plan is you would have foundation money that no matter what this market does, this money is secure. And the things in that bucket are your income, your long-term care health, so in case of health of emergency, money to heirs, making sure your spouse is taken care of. And that can come in the form of enough life insurance, enough money in your TSP that's protected. That's the main source, right? You want to make sure that percentage is set aside in a place that's not impacted, because that's the thing. If you ask people, what are you afraid of in the market crisis? Like, well, I don't want my income, or I don't want to run out of money. And the way you run out of money as a federal employee is you don't have enough income at the end of the month. And so you want to make sure that extra money that you would need for income is put into a protected bucket, is not impacted by the market, because this volatility won't be around forever. We'll get back to stable markets. And so what you want to make sure is you have that percentage there. You don't want to panic and let everything collapse at one time. So you want to have that money sitting aside. The next thing, you want to make sure you have a tax strategy. The tax strategy is super important, because when we're running our reports through our retirement analyzer and we're looking at the difference between not having a tax strategy and having a tax strategy, it's hundreds of thousands of dollars. And we're dealing with this with active clients, children who've passed on. Like, we have clients now, I have 2 clients now who it's 2 separate families, but their children have inherited their money, and every year their kids are having to pay extra money in taxes in the 30% tax bracket because that family had a lot of money in the traditional TSP or traditional IRAs, and they're dealing with that. And that's a new phenomenon because that started in 2021. And so you want to make sure you have a strategy for that. And not only that, in case you get into a long-term care situation, another situation I'm dealing with now is a client had money in the traditional IRA from a spouse. They didn't really have a whole lot. The spouse had money and they're using it for long-term care now. But because they're having to use that money for long-term care, they're paying the taxes because they have to withdraw the money. And so they're putting them in a higher tax bracket, because not only are they dealing with a deceased spouse, they're also in a single tax that not filing married anymore. They're filing single. So the tax brackets are a lot smaller. And so they're paying higher taxes. And so that's a thing. And so you want to make sure you prevent that by having a tax strategy in advance. And then the last piece, is even when there's volatile markets, those upswings, you want to make sure you're able to take advantage of those. And so that's how you go into retirement, and you really go in with peace of mind by just having a proper structure in place.